You've been told that if you work hard, save your money, and do the responsible thing, homeownership is waiting for you on the other side. That's not just wrong. That math literally doesn't add up anymore. Right now, the United States housing market is selling fewer homes than it did in 1995. That's not a typo. Fewer transactions, 30 years of population growth, 100 million more Americans, and somehow we're moving less real estate than when people were still buying CDs and using MapQuest. And in the same breath, home prices are sitting near all-time highs. Low demand, record prices. Simultaneously, if you ever sat through an economics class and remember anything at all, you know that's not how markets are supposed to work. And yet here we are, completely stuck, completely broke. And if you've been quietly wondering whether you're doing something wrong, you're not. The math is what's broken, and today, we're going to prove it. My name is Sloan, and on Sloan Invest, we don't sugarcoat financial reality. We don't sell courses. We don't work for a mortgage company. What we do is run the real numbers, so that when you make your next financial move, you're making it with actual clarity, not with someone else's commission check in mind. Today, we're pulling the curtain back on the housing market, not the version your real estate agent talks about, not the version that leads every evening news segment with, "Now might be a great time to buy." The real version, domino by domino, in exact sequence, with the actual math. Because once you understand how we got here, you'll stop feeling like you're failing at adulthood. That you'll start seeing this situation for what it actually is. A structural crisis that no single person caused and no single policy will quickly fix. If you haven't subscribed yet, do it before you keep watching. This is exactly the kind of content most financial channels won't touch, because the mortgage industry, the real estate lobby, and half of financial media have a direct financial interest in you, not understanding what I'm about to tell you. All right, let's build this from the ground floor. Let's start with the numbers, because the numbers are where everything breaks. The national median home price right now? Approximately $418,000. In 2019, just 6 years ago, that same national median was $272,000. That's a 46% jump. Not in Beverly Hills, not in a Manhattan penthouse, nationally, the dead middle of the entire country. Meanwhile, the 30-year fixed mortgage rate is sitting around 6.5%, which sounds like a manageable number until you remember that in January 2021, you could lock a 30-year mortgage at 2.65%, the lowest rate recorded since 1971. Let me show you what that gap means in actual dollars, because this is where it gets uncomfortable. Same house, $400,000 purchase price, 20% down, $320,000 mortgage. At 2.65%, your monthly payment is $1,293. At today's 6.5%, that same loan costs you $2,023 every single month. That's $730 more. Per month. Every month. For 30 years. Same carpet, same kitchen, same school district, rated a generous 6 out of 10. Same yard that technically qualifies as outdoor space if you squint. And that's before you account for the fact that the house itself costs $146,000 more than it did 6 years ago, and so you're paying more for the loan. And more for the house. At the same time, this is not a coincidence. This is not bad luck. This is the output of a very specific sequence of events, decisions, shocks, and policies that stacked on top of each other over 5 years. And once you see the sequence clearly, the market stops feeling chaotic. It starts feeling almost inevitable. Drop a comment right now. Tell me, are you currently trying to buy a home, or did you give up? I want to know how many of you are living this in real time. The year is 2020. The world is in genuine chaos. And the Federal Reserve, America's central bank, does what central banks do in a crisis. They panic/slash interest rates to essentially zero. And then they go further. They start pumping $120 billion per month into the economy through bond purchases, including mortgage-backed securities. Think of it like this. The Fed doused the economy in gasoline and threw a match at it, and then looked surprised when it burned. By January 2021, the 30-year fixed mortgage hit 2.65%, the lowest in 5 decades. And suddenly, millions of Americans who had been sitting on the fence about buying a home realized they could afford dramatically more house for the same monthly payment they'd budgeted. So they bought, and kept buying. But rates alone weren't the only fuel. COVID rewired what Americans needed from their homes. Overnight. Your apartment was suddenly your office, your gym, your school, your restaurant, and your entire social world rolled into one. A studio in the city that used to feel edgy and urban started feeling like a very stylish prison cell. Our remote work exploded from under 6% to over 18% of the workforce in a matter of months. And millions of people asked a perfectly reasonable question. If I can work from anywhere, why am I paying $2,800 a month to live somewhere I don't actually like? So they left. Manhattan shed 200,000 households. San Francisco, Chicago, Los Angeles all bled tens of thousands of residents. And every single one of them descended on Austin, Phoenix, Nashville, Boise, Tampa. Cities with already tight housing inventory that suddenly faced a stampede of buyers armed with pandemic savings, remote work freedom, and an urgent need for a home office that wasn't also a closet. The result? National home prices jumped 37% between March 2020 and March 2022. Not over a decade, 2 years. Austin climbed 61%, Phoenix 59%, Boise, Idaho was up 53%. That at the peak, nearly 6,000 homes in a single month sold for $100,000 or more above asking price for a normal house, where someone was going to do completely normal things, make dinner, argue about whose turn it is to take the bins out, binge a TV series on a Tuesday night. If you bought in 2020 or 2021, you almost certainly made one of the best financial decisions of your life. But here's the thing, most people won't say out loud. That wasn't skill. That was timing. Being born at the right moment, having the right job stability, the right savings cushion in the right life stage. And for everyone who wasn't in that position, what happened next made everything dramatically worse. By the middle of 2022, inflation was running at 9.1%, the highest in 4 decades. The fire the Fed lit had officially gotten out of control. So the Fed did what it always does when things overheat. It raised rates, aggressively. 11 rate hikes in 16 months, from 0.25% all the way to 5.50%, the fastest tightening cycle in modern American history. Mortgage rates followed in the worst possible direction. January 2022, 3.22%. October 2022, 7.08%. October 2023, 7.79%. The highest rate since the year 2000. Now, hold that thought. 7.79%. On the same houses, people were paying $100,000 over asking price for just 18 months earlier. At 7.79%, that $320,000 mortgage you were going to take out now costs $2,312 a month, compared to $1,293 at the pandemic low. Over the life of that loan, you're paying $363,000 more in interest alone for the exact same house. And here's where the math becomes truly brutal. To qualify for the median-priced home at today's rate, all you need to earn approximately $106,000 per year. The median household income in America is $83,700. That's a $22,000 gap baked into the math before you even show up to the first open house. And every single quarter-point rate increase that happened during those 11 hikes priced out roughly 1.4 million additional buyers from the market, not slowed them down, removed them entirely. The result? Home sales fell from 6.12 million in 2021 to just over 4 million in 2024, the slowest stretch the housing market has seen since the mid-1990s. We are selling fewer homes today, in a country with 100 million more people than 1995 than we were selling in 1995. But here's the thing that will genuinely break your brain if you let it sink in. Prices didn't fall, they barely flinched. The median price actually hit a record in 2024. Demand collapsed. Thus, supply collapsed at exactly the same time. And what that created was something the modern housing market had never quite experienced before: a complete freeze. And to understand why prices didn't fall, you need to understand the one thing that is quietly holding this entire market hostage. Right now, approximately 51% of all outstanding mortgages in America carry a rate below 4%. Roughly 20% of all mortgages carry a rate below 3%. If you bought in 2020 or 2021 and locked in 2.75%, you are sitting on a financial instrument that no longer exists anywhere in the marketplace. The bank will not recreate it. The market cannot replicate it. It is gone, like a limited edition sneaker that sold out permanently and the manufacturer closed down. So here's the situation those homeowners face if they sell their home and buy another one today. Well, they're not just moving. They are voluntarily surrendering the cheapest money they will almost certainly ever access in their entire lifetime and replacing it with money that costs more than twice as much per month. That swap costs $730 more every single month, forever. Federal Reserve researchers calculated the average lock-in cost, the pure financial penalty of trading your old mortgage for a new one at today's rates, at over $65,000. $65,000 to leave your house. So the rational homeowner stays. They stay in the house that's slightly too small. They stay in the neighborhood they've mentally outgrown. They stay in the town they took a job in 4 years ago, before they got promoted and transferred. Not because they want to stay, because a spreadsheet is physically holding them in place. But the Atlanta Federal Reserve found this effect reduces the probability that any given homeowner will list their home by 21 to 23%. FHFA researchers estimated this phenomenon alone has suppressed 1.7 million transactions that would otherwise have happened naturally. Active housing inventory is still 17% below 2019 levels. Months of supply hovers between 3.3 and 3.8. You need 6 months of supply for a balanced, healthy market. The housing market isn't broken in the sense that it's collapsing. It's broken in the sense that it has completely stopped moving, like a revolving door that's been jammed from both sides. Nobody can get in. Nobody can get out. Here's where this gets personal. If you've ever saved for a down payment and watched the goalpost move further away every single year, share this video with someone who needs to understand why that keeps happening. It's not discipline. It's not luck. It's math. Let me introduce you to someone. We'll call her Danielle. Danielle is 33 years old. She works in healthcare administration in a normal mid-sized city. She earns $74,000 a year, above the national median. No credit card debt. A credit score of 762. She has $31,000 saved after 3 years of deliberate sacrifice. No new car. Shared an apartment longer than she planned. Skipped vacations she genuinely wanted to take. By every responsible measure, Danielle is exactly the person homeownership was supposed to be designed for. Here's what the market currently offers her in return. In the median home in her city, $385,000. With 10% down, her loan is $346,500. At 6.5%, Her monthly principal and interest payment is $2,190. Add property taxes, $350 per month. Insurance, $150 per month. A basic maintenance reserve, $320 per month. Total monthly housing cost, $3,010. Danielle takes home approximately $4,650 a month after taxes. Housing would consume 65% of her take-home pay. She'd have $1,640 left. For food, transportation, health insurance, utilities, student loans, and the occasional reminder that she is a human being with a social life, not just a mortgage payment with a heartbeat. She cannot afford this house, not because she's been irresponsible, not because she hasn't tried hard enough. On the income required to comfortably purchase the median home in her market, meaning housing costs at or below 30% of gross income, is $110,000 per year. She earns $74,000. That $36,000 gap isn't a personal failing. It isn't a character flaw. It is a structural problem baked so deeply into the current market that no amount of hustle, sacrifice, or financial discipline can arithmetic it away. And there are millions of Daniels. Financially solid, genuinely responsible people, being told by every cultural signal around them that they should own a home by now, while being quietly, systematically excluded by numbers that never appear in those signals. Here's what that actually feels like. It doesn't feel like a crisis. It feels like opening a home listing app for the 16th time this week and saving a house you know you can't afford, just to have somewhere to put the feeling. It feels like watching your rent increase in April and realizing your down payment timeline just got 4 months longer for a savings goal you've been building for 3 years. It feels like attending your best friend's housewarming and being genuinely, truly happy for them, while also involuntarily doing the mental math on what their monthly payment must be. It feels like being responsible by almost every conventional measure and still being blocked from the thing your parents treated as a basic expectation of adulthood. And the data confirms it. First-time buyers now make up just 21% of all home purchases, a 44-year record low. The historical average is 40%. The median age of a first-time buyer is now 40 years old. In the early 1990s, it was 28. Buying at 40 instead of 30 costs you approximately $150,000 in lost equity, a decade of appreciation you simply didn't participate in. Meanwhile, baby boomers now represent 42% of all home buyers. Half of older boomers are buying entirely in cash. They sold a home they purchased for $180,000 in 1996 that is now worth $680,000, pocketed $500,000 in equity, and walked into a bidding war with a checkbook against a 34-year-old with a pre-approval letter and $31,000 saved. The downstream consequences are staggering. 84% of Gen Z aspiring homeowners say they are delaying at least one major life milestone because of housing costs. 29% are postponing having children, 18% are delaying marriage, and 1 in 6 aspiring buyers, 22% of millennials, have given up on homeownership entirely. Not paused, given up. The median first-time buyer being 40 years old is not a quirky data point. It is the statistical fingerprint of a generation squeezed so consistently, so thoroughly, and for so long that the defining marker of middle-class financial stability has been pushed from early adulthood into middle age. Here's the part of this story that almost never gets enough attention. The supply problem didn't start in 2020. It didn't start with the pandemic. It didn't start with rising rates. It was assembled piece by piece over 15 years of deliberate underbuilding after the 2008 financial crisis. The United States is currently short somewhere between 3.5 and 4.5 million housing units. Not a rounding error, not a regional imbalance, a structural national deficit of homes that should exist and simply don't. After the 2008 crash, home builders pulled back hard. They were gun-shy. Financing dried up. Consumer confidence collapsed. And for the entire 2000s, housing starts averaged about 990,000 per year, against a historical baseline of 1.5 million. And what little did get built skewed overwhelmingly toward the upper end of the market, because that's where the profit margins are. Luxury developments, high-end condos, amenity-rich communities. The starter home, the house under 1,400 square feet that served as the traditional first rung on the wealth-building ladder for working-class and middle-class Americans, went from over 400,000 units per year in the 1970s to just 65,000 units in 2020, an 80% decline in the product that was specifically supposed to create first-generation homeowners. The starter home wasn't priced out of reach. It was essentially discontinued as a product. Then, the pandemic demand surge hit. Then, the rate spike. And now, tariffs, steel up 50%, aluminum up 50%, Canadian lumber up 45%, adding an estimated $10,000 to $17,500 to the cost of every new home before a single person has moved in. Some builders are fighting back with incentives and rate buydowns, bringing effective rates down to 4.5% or even lower on new construction. And that's genuinely worth paying attention to. But the fundamental truth is this: the supply crisis took a decade to build. It will take at least a decade to meaningfully unwind. There is no policy lever, no executive order, no stimulus package that builds 4 million homes in 18 months. At some point in every housing conversation, someone asks it. Let's just address it head on. Is this 2008 again? No, not even close. And the reasons matter. In 2006 and 2007, subprime mortgages, the kind given to people with poor credit, no documentation, and no realistic ability to repay, represented 18 to 21% of all mortgage originations. Liar loans, interest-only products, negative amortization mortgages. These were mainstream products. The banking system was betting on home values rising forever, using money borrowed against itself with zero margin for error. Today, subprime lending represents roughly 3.6 to 4.2% of originations. The median credit score at origination is 758, 50 points higher than 2006. In 2009, 26% of all mortgaged properties were underwater, meaning homeowners owed more than their homes were worth. That's the condition that triggers mass defaults, forced sales, and a genuine price collapse. Today, just 2.2% of properties are underwater. American homeowners collectively hold $35.8 trillion in home equity. Foreclosures in 2024 totaled 174,000. In 2008, they hit 2.3 million. The 2008 crisis happened because banks lent money to people who couldn't repay it, against home values that were largely fabricated. Today, the lending is sound. The borrowers are qualified. The equity is real. The ownership is legitimate. And you still can't afford anything. Progress? Technically, this is not a fragile market on the edge of collapse. It is a frozen, structurally constrained, deeply expensive market that will absorb more and more of people's income, quietly, without drama, without headlines, while waiting for time to do what policy cannot. Everyone is waiting for one thing: rates to drop. And rates probably will come down, gradually. Now, most credible forecasts have the 30-year fixed ending this year somewhere between 5.7% and 6.1%. Better. Meaningfully better. But a Bankrate survey found that 37% of current homeowners say they need rates below 5% before they'd even consider selling. That threshold isn't where rates are heading this year. The lock-in effect does fade over time, organically. People retire, people get divorced, people have kids and need more space. People get job transfers they can't turn down. The share of mortgages below 4% has already dropped from a peak of 65% down to roughly 48% today. That slow release valve is the most realistic path to a more functional market. But slow is the operating word. This is a 5 to 10-year process. There is no shortcut. And here's the counterintuitive twist almost nobody is discussing. A dramatic rate drop might not fix the affordability problem. It could temporarily make it worse. Think about it. Millions of buyers are sitting on the sidelines right now, priced out, locked out, waiting. If rates drop sharply to 5%, that wave of pent-up demand floods back into the market almost overnight. But supply doesn't recover overnight. The 3.5 million unit deficit took a decade to create. So, what happens when massive, compressed demand hits an insufficient supply base? Prices spike. The same dynamic that drove the 2020 to 2022 price explosion could partially repeat itself at an even higher baseline. The cure, if it arrives too fast and too furiously, could temporarily make the disease worse before it starts making things better. The most honest forecast is the boring one. A slow, grinding, multi-year adjustment where prices move mostly sideways, while incomes gradually rise. No crash, no dramatic relief, just time. And a lot of difficult personal financial decisions made in the middle of an extremely uncomfortable market. So, what do? First, run your numbers. Not the market's narrative, not your real estate agent's enthusiasm. Your numbers. The general rule that still holds: if your total monthly housing costs, mortgage, taxes, insurance, maintenance, land at or below 28 to 30% of your gross monthly income, and you plan to stay in that home for at least 7 years, buying makes financial sense. If the math doesn't work at that threshold, it doesn't work. Now, stretching to 45% or 50% of your income because the market feels now or never doesn't make it a smart move. It makes you a future statistic. Second, renting and investing. The difference is a completely legitimate financial strategy. Almost nobody with a financial incentive will suggest it because nobody earns a commission check when you put money in an index fund. But in a high-rate, high-price environment, the math on renting and investing can absolutely compete with, and sometimes outperform, buying an overpriced home on a stretched budget. That's not a consolation prize. That's a genuine strategy. Third, if you are buying, look seriously at new construction right now. Builder incentives are real. Rate buydowns to 4.5% or even lower are available in many markets. The median new home price has come close to parity with existing home prices, something that almost never happens historically. Just make sure the incentives aren't masking an inflated base price. Run every number. Compare total costs, not just monthly payments. And fourth, understand that your frustration is completely valid and structurally justified. The income required to buy the median home is $106,000. The median household income is $83,700. The gap isn't a personal failure. It's a policy failure, a building failure, a decade of decisions failure that landed in your lap. You're not failing at adulthood. The math is broken. And knowing why it's broken, in exact detail, with actual numbers, is the first real step toward making a decision that actually works for your life. Rather than participating in collective financial pressure because everyone around you insists that buying is always the right move. Now you know. And now you can decide with your eyes genuinely open. That's the real story of what happened to the housing market. Not the version the industry wants you to hear. The version where we follow every domino in order with the real math. If this video gave you clarity, or if it just made you feel a little less crazy for questioning whether any of this adds up, hit the like button. It genuinely tells me this content is reaching the right people. Drop a comment below and tell me which part of this hit closest to home for you. Is it the lock-in effect trapping sellers? The 40-year-old first-time buyer stat? The starter home being essentially discontinued? Or are you a Danielle? doing everything right and still watching the goalpost move. And if you haven't subscribed yet, what are you doing? This channel exists specifically to give you the financial truth that nobody with a commission check will tell you. Subscribe so you never miss a video where we run the real numbers. And send this to someone who's been beating themselves up about not owning a home yet. Let them know it's not them, it's the math. See you in the next one.